Here's a hard truth. The way you're using your stop loss is destroying your account. You think you're being safe, but the reality is, big banks love traders who use stop losses incorrectly. In this video, I'm going to show you why most traders get it completely wrong, and how you can start using it the way professionals do to protect your money and win more trades. Stick around because the last tip could save you thousands. Welcome back to the channel. If you're serious about mastering Forex and finally breaking free from those losing streaks, you're in the right place. Today we're diving deep into the truth about stop losses, the mistakes, the myths, and the method the pros don't want you to know. I promise you, if you watch this till the end, you'll never look at stop losses the same way again. Let's be honest. Picture this scenario because I know you've been there. You do your analysis, find the perfect entry, and place your trade with confidence. You do the responsible thing and set a stop loss. You watch the chart as the price moves against you, inching closer. Then, it happens. You're stopped out. But just as the sting of the loss sets in, you watch in disbelief as the market does a complete 180 and rockets straight to your original take-profit level. You were right about the direction, but you still lost money. It's an infuriating feeling, isn't it? It feels personal, like there's a hidden player on the other side of the screen watching your exact position, just waiting to take your money. You start thinking the game is rigged, that your broker is hunting your stop, that the entire system is designed for you to fail. But here's the critical truth. It's not personal. The market doesn't know your name. The problem isn't that the market is against. The problem is that your strategy is aligned with the 90% of losing traders. The issue lies in a fundamental misunderstanding of what a stop loss is. It's not just a safety net, it's a strategic tool that invalidates your trade idea, and you're likely using it completely wrong. This misuse falls into three common traps. First, the arbitrary pip count. You pick a number like 20 pips, but the market doesn't care about your number, its volatility changes. Second, fear-based placement. You're so terrified of a loss that you set your stop incredibly tight, suffocating your trade so normal market noise takes you out. And the third most critical error is completely ignoring market structure. This is the cardinal sin of stop placement, placing your stop in a random zone instead of a logical level. You see, the market runs on liquidity. To big banks and institutions, your stop loss isn't protection, it's a target. It's a pool of orders. And because most retail traders learn the same textbook strategies, they place stops in predictable locations, just below recent lows or above recent highs. The smart money knows this. They intentionally push the price into these zones in a stop hunt to trigger those orders, absorb that liquidity to fill their own massive positions, and then move the market. Your loss becomes their entry point. Let's crush some common myths. First, myth #1. A tight stop loss equals less risk. This sounds logical, but it's wrong. It often guarantees you'll lose. Why? If your stop is too close, normal market noise, the random daily fluctuations, will inevitably hit it, stopping you out before your trade can play out. This leads to death by 1,000 cuts. You'll get stopped out for small losses that quickly add up. A proper stop loss needs to be placed outside this noise, based on volatility and structure, giving your trade room to breathe. Next, myth #2. Using a fixed pip stop is professional. Absolutely not. This is a lazy, one-size-fits-all approach. The market doesn't care about your fixed number. Different assets have different volatility. A 20 pip stop might be huge for a slow pair, but tiny for a volatile one. A professional stop is dynamic. It's based on market structure, placed just beyond a key support or resistance level, or uses a tool like the average true range ATR to adapt to current market conditions. Finally, the most dangerous myth. Myth #3. It's smart to widen your stop when a trade moves against you. This isn't a strategy, it's a gamble fueled by hope. Your initial stop loss defines your maximum acceptable risk. Moving it further away is like tearing up your trading plan and inviting unlimited risk. This is the single fastest way to blow up an account. If you feel the urge to widen your stop, it's a massive red flag that your initial analysis was flawed or you're trading emotionally. A real plan accepts small, defined losses. So what's the professional method? It's all about basing your decisions on market structure. Think of structure as the market's skeleton, the series of peaks and troughs that define the trend. For a buy trade in an uptrend, your stop loss must be positioned decisively below the last significant higher low. That level is the foundation of the current bullish move. If price breaks below it, the uptrend's logic is officially invalidated. Conversely, for a sell trade in a downtrend, your stop goes above the last confirmed lower high. You're not just picking a random number, you're placing your defense at the precise point where the market would prove your trade idea wrong. Next, you must account for liquidity grabs. Institutional players know exactly where amateurs place their stops. They see these clusters of orders just below support or above resistance as fuel. They often engineer a stop hunt, a rapid price spike designed to trigger these stops and create a fake breakout. This shakes out retail traders right before the price reverses and continues in the original direction. This is why you place your stop where the structure breaks, giving your trade enough breathing room to survive these predatory moves. You're placing your stop in a logical fortress, not a predictable trap. This leads to the cornerstone of professional trading, risk management. This happens, you enter. You must decide the maximum percentage of your account you're willing to risk. Professionals stick to a strict 1 to 2% rule. This isn't about being timid, it's about guaranteeing your survival. Losing streaks are inevitable. Risking a small, fixed percentage ensures you can endure them and stay in the game. First, identify your structural stop-loss level. Then you calculate your position size so that if that stop is hit, your loss equals exactly your predefined risk. Your stop placement dictates your position size, not the other way around. This is the key to long-term profitability. Notice the theme? We're not using fixed pips or guesswork, we're using logic. A static 20 pip stop is meaningless because it ignores the market's unique volatility and structure at that moment. The professional approach is dynamic and adaptive. It's a complete mental shift from gambling to strategic execution, treating your trading like a business. Here's something most traders ignore. Stop loss is not just a number, it's a psychological barrier. Many traders sabotage themselves because they fear the stop. They move it wider, they remove it completely, and that's when accounts get wiped out. You have to think like a pro. If your stop gets hit, your setup failed. End of story. Take the loss, learn, and move on. This discipline separates winners from losers. Ever heard of stop hunting? This is when the big players intentionally push price to zones where they know retail traders place stops. They grab liquidity, then reverse the market in their favor. Want to avoid being the victim? Don't put your stop where everyone else does. Learn to read liquidity zones and give your stop enough space beyond obvious levels. So now you know the real truth about stop losses and why most traders are doing it wrong. If this video helped you, smash that like button, subscribe, and turn on notifications so you don't miss the next one. And hey, check out my next video, How Banks Hunt Your Stops, the Secret Liquidity Game. That one is going to blow your mind.